Hey there, Greeley. This is the local only podcast. I'm your host, Jamie Eklund. I'm a local business person and a real estate agent here in Greeley. And today we are talking about buy downs, interest rate buy downs. And we have the pleasure of having James Clifford with Guild Mortgage on today. James, welcome.
Thank you, Jamie. Glad to be part of this.
Yeah, thanks for being here. All right. So, what is an interest rate buy down?
Interest rate buy down from a kind of a high level point of view, you can separate them into two categories. Both have the end result of getting a lower interest rate with the goal of getting your payments a little bit lower. So the two different types are, there's one called the permanent one, and that's kind of something that's been around for a long time. And basically what it is you have the opportunity to put some more money in to be able to, as a result, get a lower interest rate. So that's a permanent buy down. Now, there's another one that seems to be very popular, especially with interest rates being up where they're at, and that's called a temporary buy down. And there's different versions of that, but the kind of the short version is you can take some money and be able to get a interest rate that is lower for a short period of time. And I always tell people, don't get this confused with an ARM or an adjustable rate mortgage. It's everything's set up right at the very beginning. But what that can do is can help temporarily make your payments lower, especially for those people who want to ease into maybe a higher payment than what they're used to in the past. So temporary and permanent buy downs.
Yeah, that makes sense. I'll talk to buyers about it too. And I'm like, well, you can take $10,000 and you can buy down the rate for 30 years, which will buy down your rate just a little bit. Or
Yep.
you can take the 10,000 and buy it down for 1, 2, or 3 years, which goes a lot farther to get that payment lower. And, you know, it'll at least start your payments a lot lower. And
Right.
where the difference is, because I run into this a lot too, where people get freaked out because they're like, oh, well, what if interest rates are, 15% in 2 years? Then will my interest rate go to 15%? I'm like, no, your payment will increase with the temporary rate buy downs, but there's always going to be, you're still locked into whatever that rate was when you got the loan.
Mm-hmm.
Is that a correct
Mm-hmm.
statement?
That would be, and I think kind of getting into a little bit of the mechanics of how a temporary buy down works will probably help solidify this. So when we're qualifying someone for a mortgage who wants to do a temporary buy down, we have to qualify them at what's called the note rate. So that's the going rate. That's the one that we, at the end of the time of the temporary buy down, that's what the interest rate's going to be for the rest of the term of the loan until you refinance. So for example, let's say the note rate is 6.5%. No matter what happens, no matter what the markets do, that's going to be the end rate. Now, in order to get that temporary buy down or temporary discount in the payments, what happens is this is how it works. The bank or the lending institution is owed the full payment for that 6.5% interest rate. However, what you can do is take and put in a pot of money or an escrow account a certain sum of money. And what happens is, for an example, one of the versions is a 2-1 buy down. So your first year is 2% lower. So what happens is you pay the mortgage payment that's 2% lower. The rest of the payment is made whole from the funds that are in the escrow account, and the bank gets the money that they're owed. And then, slowly that escrow account just kind of makes those payments. Year 2, it's the 1% lower, so it's a little bit less that's being brought out. But at the end of the day, those payments are being whole. So at the end of those 2 years, the client ends up paying that 6.5%, and it never goes up at that point.
That makes sense. So it seems like, when I was a real estate agent 5 years ago, it was pretty rare that I talked to clients that would take advantage of buying down rates. And I don't even know if temporary rate buy down was even a thing Like I never did it. I never saw clients do that. Why are people doing that today?
I think there's two reasons. One is because the interest rates are higher right now than they were 5 years ago, as far as things go. So when people take a look and go, ooh, 6%, 7%, 8% interest rates versus what we were experiencing several years ago of 2, 3s, and 4s, the impact of payments is a lot more substantial. Also, too, for a temporary buy down, one of the rules that is there is it has to be funded through seller concessions. 5 years ago, seller concessions weren't a thing. In fact, we were offering over asking and having to potentially cover, appraisal gaps and things like that. So by the mechanics of things, that took temporary buy downs off the table. And I think in addition to a lot of lending institutions, because interest rates are higher and we want to continue to get people into homes financially responsibly, we've had to be a little bit more creative in helping people make those transitions, especially if people are selling a home at 3% interest and then trading it for a 6.5%. That's sometimes a little bit more difficult to do, just emotionally.
Yeah. Well, it seems like a lot of the concessions we saw 5 years ago were used very differently. Where we were doing concessions back then, it was hard to get an offer with concessions accepted, but it was always because the buyer just didn't have the cash for closing costs.
Right.
It was pretty rare that I saw anybody use those concessions for anything other than that. It was pretty rare. I don't think I ever saw it for somebody buying something down. So, but that makes sense. Higher payments. And so like that kind of brings us to the question of like, what's ultimately the goal and the impact of a buy down?
The goal of the buy down really is just to make those payments better. Sometimes we have to make them better in order for someone to qualify. So that's one type thing. Sometimes it's, I can qualify for this amount, but boy, my budget's just, I need a little bit more flexibility in my budget because everybody budgets differently, just for budget considerations. So it really comes down to its payment impact.
Sure. That makes sense. And so it seems like you really have to make the determination, what ideally do you want that payment to be realistically, right? And I always tell people this is like, figure out what's comfortable for you guys. Now, I would rather not pay a mortgage at all. I mean, 0 would be amazing, but that's not
preferable.
That's not realistic. Even if I own my house outright, I'm still going to pay money on it. But realistically, what do I need that payment to be? And then how can we get that payment there? And those buy downs tend to be a really useful tool sometimes to help us adjust, either seller concessions or cash to close and get that payment at a more comfortable place.
Yes.
So how does somebody go about getting a buy down?
I think the first place to do is really talk to your lender and just go, okay, what are the options out there? What's realistic? What are the payment impacts? Because like we mentioned at the beginning here, there's the permanent and the temporary buy down. Which direction do we want to go? Then once you know that, what you need to do is figure out what the cost is associated with that. And then once you know what the cost is associated, sometimes it's a little bit more general. We think we're going to buy a house roughly $500,000 or roughly this amount. So we can kind of get a ballpark of what those figures are. And then we sit down with our realtor and go, okay, when we're looking at homes, we know we want to be able to do this type of a buy down. So this is going to require, in the case of a temporary buy down, seller concessions, or in the case of a permanent buy down, you can pay for those either with your own money, seller concessions, a mixture of both, and figure out what does the offer need to look like when you make the offer on that house. So that's kind of how the process goes. So find out how much it is, figure out how we're going to get it and what our options are there.
Yeah, it seems like you and I have a lot of those conversations with buyers,
Mm-hmm.
and you will say, okay, here's the buyer. Okay, their purchase price is going to be 500,000 or whatever. And you'll usually tell me, and we need a minimum of $5,000 or $10,000, whatever concessions in order for
Right.
them to get their payment where we need it to be.
Mm-hmm.
So it's helpful to me because then I know when we're looking at property and we look at something that's just on the market, and it's 500,000 or more, all of a sudden it's like, this is going to be a hard property to get a deal put together and structured in a way that's going to be favorable to those buyers.
Mm-hmm. And two, from what I gather, it's a lot easier to know this. So when you make your first initial offer, you can make it right the first time, because if you have to go back and try to change all these things after the fact, so much more difficult.
Yeah, I mean, I would say, yeah, that's unless you have the opportunity to renegotiate, and when it comes to the transaction, there's really two other areas that you can renegotiate. One is inspection. And if the house doesn't have any major issues and you're like, well, there's no major issues, but we would like $10,000 concessions, that's going to be a hard sell.
Yep.
And then the last one is going to be the appraisal. And if the house appraises with no conditions on it,
Yep.
there's nothing to object to there either. And so making that initial offer what it needs to be right out of the gate is super important.
Right. Yep.
So what limitations are you seeing with buydowns?
There's a couple. Number one is, since temporary buydowns have to be funded through seller concessions. I mean, you can use some lender concessions and some realtor, stuff with that. However, it's primarily funded through seller concessions. So can you get seller concessions? So that might be a limiting factor. Since there's so many different versions of buydowns, whether it's a 1-0, a 2-1, 3-2-1, how much in seller concessions can you get will determine which option is available to you. Yeah. Then, speaking of that, we run into the issue of max seller concessions, because each program has a maximum that you can ask. For example, if you have 10% or less of a down payment on a conventional loan, you can only ask for 3% in seller concessions. That definitely will not work for a 3-2-1 buydown, just based on what I've seen in the past. So what options you might have will be dependent on your concession wiggle room there. And then I think the other side is just practicality. Like you mentioned, if something is just on the market, the likelihood of getting sizable seller concessions on a brand new home that's just on the market is pretty small.
Yeah.
But so that sometimes can be a limiting factor as well. Also, too, I think not necessarily a limiting factor, but can be, is financial impact. So are we getting the desired financial impact? Does it make financial sense at that point? So while not a limiting factor directly, it definitely needs to be part of that conversation.
Yeah. Yeah, I always tell people, buyers that are going out that need those concessions to get that payment where they're at, I just tell them, I'm like, you just need to understand that might prevent you from buying particular properties. Right, because we might not be able to get that concessions on particular properties. And most of the buyers that I work with are okay with that. They understand that, okay, well, we might miss out on a property, but that's okay because we'll be patient and we'll wait for another one to come on. That works. And I've been doing this so long now that I'm like, inevitably something will fall apart for somebody, and then we'll be patient and we'll wait, and then something else will come on the market. Quite honestly, usually it's something better that hits the market that is a better situation for those buyers. And we're able to get under contract. We're able to get the concessions they want, get the payment where they want, and things work out a lot better anyways.
Yeah.
So what are some of the reasons then that people are getting buydowns?
I think it really comes down to just a few categories. One is they just need to do a buy down, a permanent buy down, in order just to qualify. So sometimes when your debt to income is just that little bit on the high side, we're able to buy down that interest rate just that little bit. That affects your overall debt to income, or DTI. And then that kind of gets you from not qualifying to qualifying. So that's a big reason why a lot of people use those. And that's with a permanent buy down. Remember, you have to qualify at the note rate with the temporary, so that's a different thing. Number two is budget. So oftentimes people can qualify for a higher purchase price, but get the payments on that just because of their different unique family needs. They might not be able to afford that from a budgetary standpoint, or want that flexibility, especially with inflation being a concern nowadays. They want that buffer, that flexibility there. So some people will, buy down the rate temporarily or permanently just to make sure they have a little bit more budget flexibility there. And sometimes too, I'm seeing it with an ease into the higher payments. Let's just say you're renting at a certain amount. Let's just throw out 2,500. Your new mortgage payment's going to be 3,000 a month. That's a little bit of a jump. So some people might want to ease into it. So let's make your first year payment closer to that 2,500, then, the temporary buy down. And then maybe the next time it's more closer to, maybe a little bit more of that. Let's just throw out the number 275 or 2,750. And then the third year it's 3,000. It helps to ease into that. You can start making shifts in your budget. And all of that stuff. And again, just throwing numbers for an example as far as kind of what people might be thinking in that regard. So, especially if people are selling a home that's at 3% and they're going to a 6.5% right now, that ease in just overall payments is kind of a common concern. Yeah. And this is a great way to address that.
Well, I was talking to a guy the other day that said that the way his employment works is they have built-in raises every year.
Yep.
And he liked the idea of the temporary rate buy down because it would allow him, when he's making less today, to have a lower payment. And then as he makes more money, his payment actually goes up. And so it kind of scales with him. And I was like, oh, that's an interesting perspective I thought of that I hadn't heard anybody else talk about. So
that's a perfect example of a perfect way to use the temporary buy down, thinking from a budget standpoint. I like that.
Yeah. So we talk a lot about the benefits of a buy down. What are the cons? What are the downsides?
Right. As far as from a permanent buy down, typically the cost to buy your rate down usually will take a certain amount of time for the cost benefit to be realized. We're all hoping interest rates will come down. So the question is, how much time needs to elapse and how quickly will interest rates come down? Does it make financial sense to implement the permanent buy down? So that's kind of one of the concerns. It's not a huge barrier, not a huge concern. The only time where it becomes a really big concern is if people want to get super aggressive on the permanent buy down, because the lower you go, the more exponential the cost kind of adds up. And then it becomes to the point of it just doesn't make sense. It's going to take 5 years for the cost benefit, for example, to come to fruition. So at that point, it's like, no, it doesn't make sense. That's a con at that point.
Yeah.
From a temporary buy down standpoint, I know a lot of people have been using the temporary buy downs with the hope that interest rates will be lower here in a year or two, and we could refinance at the lower rate and kind of have the best of both worlds. The con is what happens if the interest rates don't come down? Worst case scenario, you're just at that note rate. And that's why we qualify you at the note rate. However, if you're absolutely banking on the fact in order to budgetarily make those payments for the interest rates to come down before 2 years is up or 1 year is up or whatever the case is, there's a risk there. So that can be a negative in this. But those are kind of the big negatives on that.
So I want to clarify something that you've said a couple times. I think I understand what you're saying. When you say they're qualified at the note rate, that means you get qualified for a loan at the full payment, and then you buy down, the 1, 2, or 3 years up to that full payment. Would that be
Correct. That is correct. Yeah. So basically what we're doing is with the temporary buy downs, we're qualifying you under the worst case scenario payment. That, I think the philosophy there is to make sure we're not setting you up for failure financially. That's how the regulations are built as well. So on paper, even if those temporary buy downs lapse and we don't refinance, on paper, you can still make those payments.
That makes sense. So you're not getting qualified on the lower payment. You're getting qualified on the higher payment.
100%. That's why if you need to lower your interest rate to qualify, that's why you would have to go with a permanent buy down in order to accomplish that. And the temporary buy down is just more of a budgetary convenience at that point.
Yeah. And when I've talked to buyers, I've helped them try to understand some of the strategy behind that temporary rate buy down. And a lot of times I'm like, well, after 2 or 3 years, if the interest rate goes back down, then you can refinance that into a better rate that's fixed through 30 years. One of the arguments that I hear with that is, well, then I have to pay the refinance fee. What's your thought on that?
Well, there are going to be traditionally some fees that are going to be a part of a refinance, but I know our company, Guild Mortgage, we are offering to waive all the lender fees that go along with a refinance, so that dramatically reduce the costs. Also, with us, we retain the servicing for probably about 90% of our loans. So the escrows that traditionally you have to bring to closing, we already have in-house. So typically with us, worst case scenario is they may have to pay for an appraisal and they may have some title fees to pay. But with a refinance, the title fees are a lot less traditionally than with a purchase. So, and those you just roll into that. So you might be looking at a couple $100 to $1,000. So it's not much, but if it's going to save you that much, like in the first couple months of payment, it's a huge net positive.
Sure.
Also, what a lot of people don't realize is that escrow account that we built to make the payments whole for the temporary buy down, if any money is left in there by the time we refinance, because we refinance before the 2 years is up, that money is still the client's. So oftentimes what happens is they just take that money, they might use it for, against the principal, they may try to use that for a permanent buy down to make the deal even better, cover some of those little small closing costs that might go along with that. So there's some flexibility there.
That makes sense.
Yeah.
So should everybody do a buy down then? Or who do you see that uses them the most?
Right. As far as a permanent buy down, I think a lot of people are using that just to kind of, in a little bit of a way, just to kind of make the things a little bit better. So they like the sound of a 6.625 versus say a 6.875. So it's a little bit about budget management at that time. And then, the people that are using the temporary buy downs just want that freedom and flexibility. I know a big one is like, okay, if I can reduce my payments a couple $100 a month with a temporary buy down in my first year or first 2 years, then I can channel that money towards some of the repairs I want to do, some of those other different types of things. So it really depends on the scenario, whether it makes sense or not, and whether people should go ahead and use those. So this is where you talk with your lender and go, okay, talk to me about buy downs. Where are we at? What's the budgetary impact? What's the payment impact on those types of stuff? And go from there.
Yeah. And I feel like as a real estate agent, this is where I lean pretty heavy on your expertise, running those numbers I'll have conversations with buyers a lot, and they'll ask me, "Well, I don't know, the payment's too high," or I'll, they'll come to me and they'll have their mortgage calculator, right? And they'll be saying,
Yep.
"Well, this is what the mortgage payment's going to be like." Well, I would say hold those mortgage calculators loosely. There's a lot
Very.
of assumptions in there that may not be reality. There's a lot of factors in this. It's not that simple. I said, but also they don't calculate in potential buy downs. And so if
Right.
that's what the constraint is for my buyers, I'm like, we need to get you connected with a lender. We need to have that lender run the numbers for you, and then they can play with potential buy downs and not potential buy downs, so that you can see what a payment would look like with or without, and all the rest, and answer all the questions. And so I lean pretty heavy on you guys for that.
Yeah.
That's way outside my area of expertise. I know enough to be dangerous.
There we go. Well, at least you know that. And, for me, when I'm illustrating this for clients, really what I try to do is just make it very clear on the impacts, the costs. I have spreadsheets that we have built just to really illustrate all of this type of stuff. Even in my spreadsheets, I have, like, if we do X number, here's the cost for this permanent buy down. Here's how many months it's going to actually take for the cost benefit to come. So we can really dig into that. One little note on those, like, say, Zillow, payment calculators that they have in there, where they
Yeah.
just kind of already have things pre-populated. You have to look at the assumptions, and you'll find that it's assuming 20% down. It's assuming a specific interest rate, which may or may not be true on that side. So that's where the disconnect is with people. If people come and say, "Ooh, you're giving me a higher payment than this calculator is giving," usually it's because, well, you only have enough for 5% down, and you have mortgage insurance at that point, instead of 20% down and no mortgage insurance. So that's just a little aside on those calculators.
Yeah. No, I always tell my buyers, I was like, those calculators are usually designed to get you excited about buying a house.
100%.
And
Yep.
so they're going to be way too favorable on all the
Mm-hmm.
assumptions. And so you don't need that. You need realistic numbers. That's where,
Yep.
having a lender that can look at your entire financial picture is going to do you a lot of good. So,
Right. Because not all financial situations are equal. And quite frankly, the opposite is everybody's unique.
yeah.
So you got to look at it from each individually to come up with the best game plan.
Yeah. Cool. Well, that's a lot about buy downs. Any other thoughts before we wrap up here?
Just one more thought. One of the other strategies I can do, and I don't want to overcomplicate this, is there is the ability to implement both a permanent and a temporary buy down all in the same deal. So they're not mutually exclusive. So sometimes we'll kind of merge those two things together and whatnot, just to kind of come up with an even better situation. So don't want to get into too much of those nuances there, but if somebody's going, okay, which one should I do? Should I do this one or this one? Usually the answer is, let's see how they fit together to come up with the best scenario.
Yeah, that makes sense, which obviously then just complicates everything on your side. And
Yeah.
that's again where I lean on you guys and say, yeah, you need to talk to James about that, because I don't have a clue.
Well, unfortunately, the company has some great tools to be able to, number one, just figure those things out, but also illustrate it clearly, concisely, so that people can grasp and understand what's going on, so they can make the best decision for them and their family.
Which I think is really important, especially with temporary rate buy downs, because I always tell my buyers, like, make sure you understand what that payment's going to do, because it's going to
Yep.
change every year depending on how it's set up until it gets to that full amount. You just need to be prepared for those things and know exactly what's going on. And that's where having a good lender, I think, is super important, because you need to have somebody that you can call and say, hey, I need to know, when is my payment changing again, all the rest, and have all that information so that you can be prepared for something like that.
Exactly. And don't be afraid. If you're talking with your lender and you don't quite feel like you grasp it or understand it, keep asking those questions.
Yeah.
Because the worst thing we can do is you get surprised and then all of a sudden, you're in a budget situation where you're just like, okay, now how am I going to make it work? Make sure you grasp it. Don't be afraid to go, explain that to me again, maybe a
Right.
little bit differently so you actually understand it. Because sometimes for some people it's going to click immediately, for some people it won't. But please do not hesitate to ask the questions on that one.
Yep. I don't blame you a bit for emphasizing that. And people will go to me and sometimes ask the question, and these are one of those things I'm like, well, I will defer to James. Make sure you connect with James because I don't
As I
know.
do with many other things on the contract side of things for
Yep.
realtors. So talk to
Okay.
Jamie.
Yeah, cool. Well, I appreciate your time, James. I mean, the buy down thing is definitely a hot topic right now.
Agreed.
It seems like we're doing a lot of them these days.
Hmm.
And so trying to help people get a payment, really trying to help people get affordability, you know,
Yeah,
where they're trying to figure out how can they buy a house, when the payment's super high. And this is just a little bit of a tool in the tool belt to try to
yep,
help them win in the payment world and buy a house at the same time. So,
agreed. Yep.
well, I appreciate your time. Um, and we'll talk to you later, I guess.
Okay, thanks for having me on.
All right. Thanks, James.